Hello and welcome to Investors Hangout, your weekly guide to making smarter financial decisions. This series is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research.
It's World Investors Week and Deepak Pawate has sent us 8 questions which I thought were timeless.
And these are the questions that we think every investor has in mind but rarely gets answers to. So who better than Dhirendra Kumar to answer all of these? Welcome, Dhirendra.
Thank you.
If inflation averages 6% over the next 20 years, how much should investments compound annually to double your purchasing power after taxes?
To build wealth over time, you have to be conscious of 2 things. That you have to beat inflation, because if you don't beat inflation, your money remains constant. Second is that you have to beat inflation post paying taxes. If your money grows by 10%, and you pay 12.5% of the gains on that as tax, then you have to look at it post-tax, post-inflation. And the simple thing is that inflation has been stubborn over the last 10 to 20 years and averaged around 6%. Assume the worst case scenario is that if inflation remains 6%, then in 12 years' time, following the rule of 72, your capital will be half the worth. If you have 1 crore of rupees and that crore of rupees remains 1 crore, and in 12 years' time, its purchasing power will be only worth 50 lakh rupees. Based on broadly, roughly. It entirely depends on what you're spending on or what your expenditure structure is going to be. It will also require patience, discipline, the kind of noise that we are in the middle of. Every day we get anxious about our investment, the worth of our investments going down in value. Some new distraction comes and it's not distraction. To begin with, it looks alarming, it looks devastating. So the kind of country we are, where everybody has deep belief in fixed income, and we have historically high yielding fixed income, even though it was not inflation beating. So fixed income won't beat it. Your deposits won't take care of it. Just being a saver won't help. You have to, look at options which will beat inflation and look at your post-tax return.
Now, the next one is, what is the opportunity cost of keeping 10 lakh rupees in a savings account at 3.5% versus investing in an index fund averaging 12% for 15 years?
At 3.5%, your 10 lakh rupee becomes something like 16.5 lakh rupees. Pre-tax, you have to pay taxes. You would have paid taxes or annually. But assuming, pre-tax, it is 16.5 lakh rupees. If you earn 12% on your investment on an average, some years it will be low, some years it will be high, and if it earns 12%, that money will become something like 55 lakh rupees. This is a sizable difference, and this difference is not, it's not only significant, it is very important that everybody should aspire for it, because this is beating inflation, it is protecting the worth of your capital. It will be, and you are spending time with your money. Your money is locked in for a long period, or you have stuck your money. It will be needed at a time when your earnings will go down. This is the money where, this is also pre-tax. But there's a likelihood that here the taxation rate will be lower because it will be equity. So you have to aspire for higher return. You have to aspire for optimizing return on your investments. Be methodical about it. Be patient with it. And be disciplined about it.
Right. Now, the next question is, which builds wealth faster in India today? Is it entrepreneurship or long-term equity investing?
It's a very difficult question, and I think it's a wrong question. Entrepreneurship is not a choice. If you have to, if you are passionate about it, something, if you are temperamentally suited for this, you are temperamentally suited for inconsistent income, you are a creator, you have to be an entrepreneur. Many people just want to be methodical about their day, about their career, about their life. So it's not a right comparison.
Yeah.
And people can be successful in both. The wealthiest people in the world, if you look at the 500 people or 1,000 people or the generational wealth, they are either inheritors or entrepreneurs. There are very few investors. There are very few professional executives. Professional executives are successful. They are not necessarily very wealthy. When we think of entrepreneurship, one should not forget that we only listen to the success stories. We don't hear the failures. We don't hear about the losers. Typically, for most startups, in the US, which is a very evolved ecosystem for startups, only 5% survive the first 3 years. So when 95% die in the 3 years of their starting up, one can understand that what is, it's a Darwin's theory at work, survival of the fittest.
Right. Now, the next question is something that I think most of us have it in our minds. How do you decide between paying off a loan versus investing in assets when both have similar returns or interest rates?
Carrying a loan and investing at the same time is like capitalizing on an arbitrage. You are expecting that the return on your investments will be higher. And the money that you have borrowed, on which you are accruing that, you are spending the interest, will be lower over a period of time, over a longer period of time. And in this context, the only thing which comes to my mind is only a home loan, only a housing loan, because that's a long-term borrowing. The rates are reasonable. And if you are taking a measured risk, if you are disciplined and if you are methodical about it, there's a great likelihood that you will certainly earn more than the cost that you'll be incurring. But all other kind of loans, you could be in for a great difficulty. If you are likely to get dysfunctional as a result of it, it's not worth having it. Buying a home to live in is one part. Speculating in real estate is another story altogether. The problem is that many a times you get stuck. There are all kind of risks which you are assuming, and you are not aware of the risk till it visits you, till it hurts you. Builders can go wrong. The project can get stuck. Regulatory things. And we have seen it in Delhi. We have thousands and thousands of housing projects which got stuck. And about 10, 15 years ago, before the RERA the regulations came into being, we have the biggest builders who are still in jail. So they defaulted, they are still in jail, they went and they were not segregated, they were not disciplined businessmen, they were unable to deliver many of the properties which people are living in because they got stuck. They're still not registered. And I see this nightmare. So many a times in our optimism, we forget the downside of it.
Now, the next question is, you also spoke about safe investments. We've spoken about FDs. So that comes to asset allocation. So if you had to build generational wealth, what balance would you keep between risky, high growth assets and defensive assets?
That also will depend entirely on my experiences and my scale. If I'm able to accumulate something which I'll be requiring, the income from which I'll need in my retirement, then I'll go a little conservatively. If I retire at 65 and if I have a whatever investment and 4% return on those investments will be required for me to sustain myself, then I'll be 60-40 into equity and debt. If it is going to be just 1% of it, then I could well be 80% into equity. If it is going to be 0.5% of it, or if it's going to be 0%, I have some other income stream coming from I own a house, or I'm getting some rental income, or I have any other stream, some pension, then it could be entirely into equity, but entirely into equity is undesirable. In the worst case scenario, when I become extremely risk averse, I will have at least a quarter of it in fixed income, so that I'm able to capitalize on opportunity as and when things turn very grim. And that is when equity go down in value, and then I will have some money in fixed income to deploy it. And this is something where when the markets go down, this 25% or 40% will provide the kind of stability. It will not distract you. It will not unnerve you. And that is more important than just looking at the return. Looking at the downside, looking at the risk tolerance, looking at the drawdowns is just as important. Return comes second.
Right. So what systems would you put in place to avoid lifestyle inflation as your income grows?
One is that build an accumulation that you are likely to need no more than 2% of the annual return on that. That way you will have a lot of headroom. And in the worst case scenario, because one is to worry about the lifestyle inflation. Second is to ensure that you will have more than enough, assuming you are not going to inflate your lifestyle. If you are not going to aspire for new things, at least that much will be protected. And have as much fixed assets that you require that you will consume. If you have sizable things, have your home, have your holiday home, vacation home, that will save you money. Maybe try and look at some income stream from those other assets, and make sure that it is more than enough. If 2% annually is needed, you are in the extremely safe zone. If 1% needed, you can enjoy extreme luxury, because that is when you will have those equity even in your retirement, which will be able to give you all the cushion, grow, and support more than inflation, the growth, the income that you require.
So, is wealth better created by maximizing income or by optimizing compounding investments?
It is not this or that. It is both, because if you don't earn well, you can't save well. If you don't save, you can't invest more. So you have to earn, you have to save, and you have to invest, and you have to invest appropriately at different phases of life to maximize it. So it is not a this or that. It is both, and consistent, and for 30 years being disciplined about it is what matters, which brings about a difference.
Now, today's last question: how would you structure a portfolio to withstand a black swan event such as a pandemic or any other crisis?
I don't think you can ever prepare for a black swan event, because it depends on what kind of thing that can happen. Its future is uncertain, but you can do some essential preparation. Same stuff: emergency fund, the health insurance, the life insurance. The black swan event for a family could be completely different. The bread earner went to work and never came back. That could be a black swan event for the family. It is not an economy, not the country, So those things are best done with your emergency fund. Little liberal one. You can lose your job anytime. You have prepared for 6 months, maybe prepared for 1 year. So you have to really anticipate that what could be some of those things, and being better skilled, having these financial frameworks in place, having your house if you can save rent, that I think is a very important thing. So if you have done these 4-5 things, the rest of the thing, pray and upgrade yourself.
Right. So there you have it, 8 timeless questions and 8 clear answers. So wealth isn't built overnight, nor is it built by chasing fads. What you need is patience and discipline. Thank you for watching Investors Hangout, and keep sending us your questions. We'll answer the ones that matter to most investors. Take care. Bye for now.